Hello and welcome to today's premium account market update for August 2015. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, Managing Director of Investor Signals, have over 17 years of experience in the financial services industry and a current licensed and derivatives advisor. The format for today's presentation, we look at a quick macro update as we review the global ETF picture. Today we focus on the ASX top 50 stocks, in particular looking at the growth rate between FY15 earnings, which we're about to see confirmation of those announced over the next 4 to 6 weeks, and looking at the forecast run rate both at a earnings per share level and a dividends per share level into 2016. We look at the technical trends taking place within the top 50 stocks and we tie that back into our portfolio allocation. Now, on client accounts, we've been pretty aggressive over the last week or so with derivative positions, so part of today's recording will be a focus on those derivative overlays and the payoffs that we've achieved through the covered call strategy, and conclude with a short-term market outlook. The Investor Signals Premium Account Service is a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend date, trying to generate above average cash flow from the call options and the dividends, while still looking for some capital growth. It's a strict investment mandate, therefore suitable for self-managed super funds, and importantly, the assets remain in your name. Okay, starting off with the global macro picture. Up on screen there, the iShares, and I've chosen sort of four major global regions here, and in the top left-hand corner is the S&P 500. So US equities continue to trend higher, albeit they've started to consolidate a little over recent times. And I'll just go to sort of the overnight news on the US market. So we've seen mixed economic data out overnight, where we've seen slightly weaker jobs number. However, that contrasted against a much stronger ISM, which is the services index, was actually at a 10-year high for the US economy. So consumer confidence in the US remains robust, so does the housing and construction. Arguably exports a little bit impacted by the higher US dollar. However, generally the US economy continues to perform well. We've seen the June quarter GDP come in at around 2.3%, which was a big jump from the March quarter, and we'd expected that. We've seen in the past these patterns of the winter periods, December and March GDP numbers fairly weak and then strengthening during sort of that June, September. What that means globally is global GDP is tracking at around 3%, which is probably about 1.5% short of where I think it needs to be. US GDP at best is probably tracking at somewhere around 2% on an annualized basis. So moving through these graphs on screen, S&P 500, generally global equities traded about 20 times trailing earnings, and we've seen the global earnings come down from a forecast rate of around 11%. So looking for, in general, companies to deliver earnings growth of around 11%. The results have come in far less than that, and that's largely been impacted by the energy and resources area of the market. Strip those out and underlying growth probably somewhere around 8%. However, when everything's sort of viewed in its entirety, global growth within the equity market's only running at about 4%. Given where the high PE valuations are and there's no further room for interest rates to fall, I think it's really important to emphasize to equity investors that the most highly probable outcome for equities is a long period of consolidation. As I move through these, we'll chat about central bank policy. So in the US, on a forecast basis, I think we look for around 4 to 5% earnings growth over the next 12 months. when we move here into Europe, obviously Greece has been a drag. We just started to see some sign of early GDP recovery in Europe. The problems in Greece have sort of derailed confidence a little, but arguably that's now starting to sort of move into the rear vision mirror. And I think this is just a critical part to global equity markets actually having another leg higher over the next 12 to 18 months, is that if we start to see better data come out of Europe, you're going to see a base or a floor put in China. China export data will pick back up again, and I think there's a chance that there could be another leg higher to this bull market. But I think investors are going to be a little bit cautious given the high valuations and the patchy earnings at the moment, and it's not until we actually start to see some of that evidence or assurance that Europe's starting to stabilise and deliver growth that we've got a chance of some synchronised global growth, which is essentially what's been missing. Is that you may have the US doing well, Europe not. You may have US doing well, Japan doing okay, but problems in China. So we just haven't had this period where really the global economy's been firing on all cylinders. So moving down here to this bottom left-hand graph is Japan. We've got quantitative easing in Japan. You've got quantitative easing in Europe. Both of those are still continuing to put cheap capital into the global economy, which again continues to underpin equities. Over on the right-hand corner here, we've got the Hong Kong iShares, and we can see there that they've consolidated and moved sideways off the back of a faltering sort of Chinese economy, and I'll have a look at that at the moment. Up on screen is the iShares Global 100, so this is a basket of the top 100 companies by market capitalization, and we've seen ongoing growth over the last sort of 3 years within that space. Up on screen now is the iShares China Large Cap Index, and in general the Chinese index has pulled back roughly around 30% and maybe starting to consolidate a little here at the moment. If we see patching numbers out of Europe, I think there's another leg down in China. If we start to see things stabilize there, I'd expect the Chinese index to put in a base or a floor at or near these levels. Emerging markets, so areas within the global economy that have been under pressure, so Brazil, in general, emerging markets. That's partly a result of higher US dollar, the prospect of raising interest rates in the US, and obviously problems in general China and Brazil. We've seen commodity prices hit. So these emerging markets have sort of been one area where we've had outperformance, and then obviously sort of Europe and China has probably done better on a relative basis. Before I move into the ASX Top 50 stocks, if you're interested in discussing with me running an investor signals model portfolio, please contact me using the details on screen. On that note, let's jump into the ASX Top 50, and I'll move through them quite quickly. Okay, up on screen there is the XJO. The Australian market trades at about 15 times forward earnings, looking for earnings growth somewhere around about 6 to 8% over the next 12 months. The market tracking just over a 4% dividend yield. My base case is that we continue to move sideways within this shaded area on screen. Any pullback to around 52, 5400 is good value. Arguably any rally back up to around 6,000 is time to sell, just simply because the earnings growth is not there at the moment to support that. So let's go into the top 50 stocks and talk about the strategy that we're running on the internal account and on client accounts. AGL's expensive up here. The issue here for AGL is it's compressed down to less than a 4% dividend yield. The company's focus on cost cutting, divesting assets, and ultimately over the next 18 months increasing dividend policy and returning capital to shareholders. I think investors have sort of rushed ahead of that. I don't see too much more upside from AGL. Certainly any pullback to our fair value at $15.50, we're buyers of it over the months ahead. From an earnings outlook perspective, over the next sort of 3 weeks, we'll look to see AGL deliver earning guidance of around 6 to 8%. Asiano not doing it there at present. Amcor, so this is one of our favourite stocks. We hold it in the portfolio. It should deliver about 8% earnings growth. It's trading only on about a 3.5% yield on current numbers, allowing for about 8% earnings growth over the next 12 months, put the stock on about a 3.8% dividend yield. So it's still expensive, trading about 19 times earnings. However, relative to the rest of the market, we've got earnings certainty, a reasonable dividend yield, benefit from the Australian Aussie dollar, so we want to own this, and we're selling covered calls. We're getting around 30 to 40 cents of income for those call options over the next sort of 3 to 6 months. Combine that with a dividend, we're earning about 10% cash flow on an annualized basis out of Amcor and allowing for some capital growth. AMP not doing it there at the moment, albeit I had flagged that around $6 was a reasonable buying opportunity. Looking for the stock to deliver earnings growth of around 10%. From 15 into 16, puts the stock just over a 4% dividend yield, trading about 17 times earnings. ANZ, we've just seen them in suspension today while they announced their capital raising intention. So we're seeing all the banks having to shore up their Tier 1 capital. We've seen NAB go first. Now we've seen ANZ raising $3 billion. We're going to soon see CBA and Westpac follow suit. This is likely to weigh on the share price, but it doesn't change our view that the banks are at or near fair value, trading at about 5.5% dividend yield, maybe about 5% underlying earnings growth. I think it still makes sense to own the banks, but as I'd highlighted when we'd flagged this as a buying opportunity in the banks, the comment in my last recording was don't expect the banks to recover any more than 50% of this sell-off, and that's effectively what we've done, and we've ran into resistance. So in client accounts, we've been pretty aggressive selling covered calls over the banks, so we're getting the benefit of that extra cash flow from the call options plus the upcoming dividends. In all four of them, CBA first to pay its dividend in the next couple of weeks, and then ANZ, Westpac and NAB later in the year. But again, we're getting the benefit, sort of two bites at the cherry there with the call option and the dividend in the banking sector. ASX, this has been a great trade for us. We picked this one perfectly. We added it back into portfolios at around $39, $40, and we've taken profit at $44.30, which was just about at the high point a few days back. So we've locked in that gain, and the logic really for doing that is I don't see the ASX will grow earnings any more than 5%. Puts the stock at 20 times earnings on a 4% dividend yield. I think there's some risk that they announce that they're going to increase their capital expenditure on the technology side. Any pullback back to around $40, we're aggressive buyers of ASX again, but that was a great trade in client portfolios where we added roughly 10% return in a space of about a month, and we'll have a look at that on the other side of the dividend again. AZJ, again, we own this at lower levels. We've taken profit at around this sort of 525 to 550 level. I'd maintain that the stock's getting expensive up there. It's trading 20 times earnings on a 3.7% dividend yield. I don't see that the company's likely to beat on the earnings. We've seen a slow sort of trend in retracting revenue growth, so still growing, but not at the same rate it was. Likewise, in the profit, we've seen profit margins come down from high sort of mid-teens, 15, 16% profit growth down to about 9%. I think this result coming out in the next couple of weeks will probably indicate growth that's maybe somewhere more like 5 to 8%. I think in that environment, a pullback to around $5 would be a good buying opportunity for Horizon, and that's on the radar to add it back into client portfolios after owning it at lower levels and profiting from this sort of rally that we had from around 480 up to 550. So happy with the way that we've played AZJ. BHP, obviously all these resource stocks are under pressure. Maybe at the moment there's a little bit of bargain hunting starting to sniff around. I really think that's on the premise that if Europe can start to grow over the next 6 months, then China, we're looking at probably the low point for the Chinese economy and the Chinese stock market right at the moment. So I think there's a little bit of money getting ahead of that potential development. You've got a lot of offshore hedge funds and fund managers in general that are short the resource stocks, so there's going to be a lot of short covering that has to happen. We just need to be mindful that if the uptrend gets underway, it could have a little bit of momentum to it. In saying that, I think it's something more like over a 6-month play. I don't think it's going to just simply happen over the course of the next few weeks. We've been reasonably aggressive with selling call options over BHP, trying to collect some extra income plus the upcoming dividend. The view is that if we start to see that recovery in Europe and we get an opportunity where BHP moves into an uptrend over the next sort of 1 to 3 years, we'll have an opportunity to sort of buy in a number of times, take profit at the top, allow it to pull back and buy back in on the dips. But looking for evidence that BHP is turning around. From a production, that in general the resources delivered pretty solid production numbers. When we look at what's happening overseas, whether it be Exxon or Chevron, the big oil majors delivered pretty average earnings results in the US, and the share price have remained under pressure. Iron ore prices have ticked up a little bit. Certainly petroleum prices remained under pressure after the small bounce that they've had over the last month or so. But there's no real catalyst, I think, for BHP's earnings to surprise on the upside. Maybe the dividends at risk a little, but the puts of stock still, around 5 to 6% dividend yield. So one would think that we're probably looking at a support level one way or the other. It's just a matter of whether it trades sideways or we start to get a little bit more of a recovery to the upside. But that'll be an earnings result that we watch with a great deal of interest. Brambles have been pretty aggressive here on the covered calls. I don't see the company delivering earnings at the high end of expectations. I think we'll see a number around just over $1 billion, which will put the company on earnings growth of around 5 to 6%. That still allows for the currency conversion, so the underlying business I don't think is growing that well at all, albeit again reasonably stable. I don't see any sort of major risk to the downside there. So the stock at these levels though trades at 20 times earnings on a 3% dividend yield. So we've been aggressive with the covered call. We're getting around 25-30 cents for that call option. So combine that with the dividend, and we're bumping that cash flow up, from around 3% back up to around 10% per annum. I don't see much in the way of capital growth out of Brambles. So to me, you have to be running the covered calls strategy in order for it to make sense. CBA, the same thing. We've been aggressive here. We're selling the covered calls at $88. They're European style, so we collect the upcoming dividend of around $2.25. We're looking for CBA to deliver about 5% earnings growth. Combine what we received from that call option, and we're effectively collecting $3 of income over the next 8 weeks as a result of the strategy over CBA, and I don't see too much in the way of capital growth above $88 over the next couple of months for CBA. So the call option strategy there makes perfect sense. We've been reasonably aggressive here on Coca-Cola as well. We're collecting around 35 cents of income for the call option here in Coca-Cola. Combine that with the 20-cent dividend, we're generating around 55 cents of cash flow out of Coca-Cola across the next 6 weeks as a combination of the dividend and the call option. This will be a really interesting earnings result. The CEO's come out and said that she doesn't expect earnings to fall as they have been for the last 2 years. The market's really not pricing in anything in the way of earnings growth. I think the market will just be relieved to see that the earnings the fall off in the earnings have stopped. On that basis, it puts the stock on about a 4.5% dividend yield. So I think my view is somewhere around $9.50 is about fair value for Coca-Cola. Computershare. So this is a name that we own. Again, we've been aggressive with the covered calls, and that was simply on the basis that at around $13, the stock didn't really have the earnings support to drive a price any higher than that. But these US dollar earners are certainly where the stability probably is from an overall earnings picture in the market. So from Computershare, it trades 15 times earnings on a 3% dividend yield. We're seeing pretty patchy earnings growth. Maybe we get confirmation in the next week or two out of the earnings result where the company's growing earnings maybe 5% at best, and still that doesn't change the outlook too much, in that around this sort of $12 to $13 is the price range. You need to be selling covered calls to justify owning Computershare and boosting that cash flow from that 3% yield up to around 10%. CSL's had a terrific run. We were buyers off it around this sort of $86 to $88 level. When it rallied up, we started selling the $94 calls, which effectively gets us out of the stock at around $96. CSL will pay a dividend somewhere in the order of close to $2, maybe $1.90. I think that sort of will put the stock back at around that sort of $98 range, $98 to $96. So hopefully we're sitting at or near sort of the fair value price once the dividend is paid out with CSL. But where it sits at the moment from a PE standpoint, albeit underlying earnings are growing, somewhere in the order of maybe 10 to 15%, the stock's still trading on less than a 2% dividend yield and about 23 times forward earnings. Caltech's not doing it there at present. Crown Casino, we haven't bothered adding this into portfolios. It's had a bit of a bounce from a relatively oversold position. We're still seeing pretty negative data, say out of Wins, which have big exposure to Macau. The Crown Melbourne asset seems to be performing well, but the expectation is there that given that Macau was contributing roughly 50% of the profit to Crown Resorts Australia, I think there's some concern that maybe the earnings result doesn't surprise to the upside. So I think we're just sort of waiting to see these numbers come through before we really take an aggressive stance or view on Crown with respect to adding it to client portfolios. Goodman Group still looks good but expensive up here. I think on a 3.5% dividend yield, growing earnings at about 7 or 8%. Happy to take a look at it on any major pullback if we're to see, for whatever reason, a sell-off in the market. And Goodman was back at sort of $6. Happy to have a look at it. Otherwise, our preference has been exposure to GPT, and this has certainly paid off for us. We're pretty aggressive buyers at GPT down here around this 430 level. We've sold calls up at 470. We got around 15 cents for those, so our effective exit price is $4.85. When you combine what we collected in the call option plus the dividend, again, we're getting about 10% cash flow from GPT, plus we've had the capital gain from sort of $4.30 up to effectively $4.85. So that's been a good addition to client portfolios. IAG within the insurance space, I'd mentioned in last recording where we have Berkshire Hathaway come in and inject $500 million and effectively take over 20% of the reinsurance business for IAG. That's a great backstop, and I think it gives investors some comfort over the coming years that IAG is a reasonably safe place to park money. From a dividend yield perspective, the stock pays about a 5.5% yield. I think the issue there a little bit short term is earnings growth. I don't see much in the way of earnings growth, maybe 5% at best, but again, owning the stock and selling the covered calls, we've gone out till December, sold the 625 calls. We're getting about 10 to 12 cents for those. If we add that 10 or 12 cents onto the dividend that we're collecting of around sort of 34 cents, you're getting up to about 50 cents of cash flow off IAG each year, which again boosts that up to pretty close to 10% return. IPL, now this has to go onto the watch list. If we see another leg down to around this 350 to 340 level, I think IPL's a buy. Over the next 2 to 3 years, the company starts to de-risk after its capital expenditure in Louisiana. I think there's a prospect of increasing dividends, maybe return of capital to shareholders. 350 or 340, it's on the radar to add it back into client portfolios. James Hardie, not doing there at present at the moment. Lendlease, continue to like this on any pullback. So on forward earnings growth, probably something in the order of around 10%. The stock trades on a 4% dividend yield, and a buy here at $15.50. We've been going out and selling calls into December at around $16.50. We're getting around 50 cents for those. So when we combine that 50 cents of income with the dividend, again pushing that back up to around 8-9% cash flow out of Lendlease and allowing for a little bit of capital growth there as well. Medibank Private, so this is one of the names that I maintain we're probably likely to see the company surprise on the upside. I think they'll certainly deliver prospectus forecast. They'll pay their first dividend, which will be roughly 5 cents in September. I think the stock's worth certainly back up at around $2.30. And I think we're probably, we'll look back and recognise this is one of the sort of great buying opportunities, Medibank Private at around $2 back at the issue price. So we continue to add MPL into client portfolios. So where there's new capital available, this is one of the names we're adding back into portfolios at present. Macquarie, I think this comes onto the radar, but as I'd mentioned, we're really looking to see what happens in Europe. I think if we get sort of 2 to 3 months out and growth starts to pick up in Europe, arguably there'll be another, maybe 1 to 2 year rally in the bull market on the back of sort of a synchronized global growth picture. I think that's the best scenario for equities. I think the most probable scenario is we continue to sort of bumble along a little and have more of a consolidation pattern, and that really lends itself to an environment where you want to be selling the covered calls to drive the income. But certainly we keep an eye on Macquarie for a change of strategy there in the months ahead. National Australia Bank, as with all the banks, as I'd mentioned, roughly 5% underlying earnings growth. Not much in the way of increased dividends or some of those tailwinds that the banks have enjoyed or shareholders have enjoyed over the last 6 or 12 months. So I think the strategy is moving sideways, sell the covered calls and drive the cash flow out of them over and above the current dividends. Newcrest has hit a low. Look, it was interesting, the production numbers out of Newcrest. They're certainly starting to ramp things back up closer to around 2.5 million ounces of gold per annum. Their copper production numbers were down a little, and obviously they're facing headwinds from both low copper prices and also from the gold price. But I still maintain that the stock fair value, look, analysts have a range anywhere from $22 down to $7. My view on it is gold at or near where it is at the moment. Newcrest is probably worth something around $15 to $16. But it's probably an area of the market that it's pretty difficult to call when or if there'll be a bounce or a significant recovery in gold prices. Origin, this has been under pressure. We've seen them divest their New Zealand assets, helping to pay down debt, reduce the company debt from around 12 billion, maybe down to around 8 or 9 billion. There's not too much in the way of positive news around Origin at the moment. I think maybe the picture gets a little bit better as we go out into next year, but not doing anything too much there. For clients that hold it, in some cases we've taken a pretty aggressive stance and sold the $11.50 calls just to keep driving income from an asset that we don't see has too much short-term upside. Not doing it there in Orica at the moment. Oil Search, the same thing. We've been reasonably aggressive with selling covered calls over Oil Search. These energy names, I just don't think there's a catalyst over the next month or two for them to really push too much higher. QBE, we certainly like this name. I think this comes under the radar and starts to get added into client portfolios. The company should deliver earnings growth from last year, something in the order of around 25-30%. We'll see the dividend tick up. The company's been pretty aggressive on cleaning up their balance sheet, divesting assets. I think we could see a dividend yield, maybe pushing back up to around 4.5-5%. So a buy here at these levels and selling a covered call at around 15.50 makes sense in QBE. Rio Tinto, as with BHP, this is one where we'll really sort of take note of the upcoming earnings result. The story is pretty similar across these commodity names in that if Europe stabilises, starts to deliver increasing GDP growth, then China would have put in a floor, and we start to see a slightly better backdrop for these names over the next 6 months. South 32, nothing there. So SCG, which is the Centre Group, the old Westfield. So we've seen these property trust names outperform relative to other areas of the market. I think on the back of sort of the prospect that bond yields don't seem to be ticking up, and we've seen the US 10-year Treasuries sort of pull back a little. Coming into the upcoming dividend season, monies continue to flow into these names. SCG at around $4 though looks reasonably full value to me, and to the extent that we own it, selling covered calls I think is a sensible strategy there. Seek, we've seen them downgrade their earnings. The stock's bounced back. I have some concern that there's probably further to play out in this story. If we had another leg back down to around $12.30 over the next 6 months, happy to take a look at Seek, but not doing anything there short term. Stocklands. So this is back at fair value at around $4.25. So we've gone out and sold covered calls at around the $4.40 level, getting an extra sort of 10 cents or so for that. Combine that with the dividends, kicking the cash flow yield up to around up to around 10%. Looking for dividends of around 24 cents a year. So if we can get 2 rounds of calls away each year, brings in roughly an extra 20 to 25 cents, and that's how you get that cash flow jump from 5% up to 10%. From an earnings growth standpoint, I think Stocklands will probably deliver something in the order of around 7% earnings growth, but happy to add Stockland back into portfolios at around the current levels. Sonic Healthcare, so interesting, this was a name that if you go back to last recording, I'd mentioned that I thought maybe I'd got this wrong, where we had owned it at lower levels and we'd taken profit, and then the stock continued to push higher. I had great concerns that Sonic would not meet its earnings expectations, and they've come out just in the last week or so and actually stated that to be the fact. So even though the market got pretty excited and pushed Sonic from sort of $18 up to $24, really the market had it wrong, and the company's come out and highlighted what I thought the concerns were, which was that the prospect of them delivering earnings growth beyond any sort of benefit just from currency conversion, so from the lower Aussie dollar, was really what the concern is, and the company's highlighted that that's the case, and I think therefore it puts Sonic back on fair value somewhere around sort of $19.50 to $20. So my thinking here is that we probably just give it a little bit more time, maybe wait and see until the earnings result comes out. Pull back to around this 1950 might be an opportunity to buy back in. That'd put the stock back on about a 4.5% yield, and assuming nothing in the way of earnings growth over the next 12 months, you've probably got an environment where the stock finds support and bumps along sideways, sell the covered call, and it starts to deliver a reasonable return. Suncorp delivered an okay earnings result, about 88 cents of dividends. On a forward basis, the company will deliver maybe something in the order of 8 to 10% earnings growth, and I think arguably there's a place in portfolio for Suncorp with a buy right strategy as well. Not doing there in Sydney airports at present. Transurban, we continue to like this. We own it at lower levels. We've been pretty aggressive with selling covered calls. Transurban won't pay a dividend until December. Roughly around 40 cents on an annualized basis. Maybe we see that push up to 45 cents into next year. But at these levels, the stock's reasonably expensive. And just to sort of give you a number on that, it's trading on a dividend yield at the moment of around 4% at best. So I wouldn't think short term, given that the dividend payment's not occurring until December, the stock should push too much higher. So we've sold calls at around the 9.90 level. We got around 25 cents for those. So we're effectively sitting up at a sale price of around $10.15. Looking to collect that premium. Hopefully the stock settles under $9.90, and then we can sell the option again into the December or early part of next year, and again boost that cash flow up to around 10% from Transurban. Telstra, we continue to like this name. It's a defensive addition to portfolio, should grow earnings at around 3 to 5%. The stock trades on just under a 5% dividend yield where it is at the moment. We've been selling the $6.50 calls. We got 10 cents for that. So over the next sort of 2 months, instead of just collecting the 15 cents from the upcoming dividend, we're effectively getting 25 cents of income there. Westpac, we've been pretty aggressive selling calls over this. As I'd mentioned, we didn't expect the banks to bounce back any more than 50% of this rally. So I've taken the opportunity to sell the covered calls. We've generated around 70 to 80 cents of income for those. So again, we'll collect the upcoming dividend and cap out the upside from around sort of 35.50 in the banking stocks. Wesfarmers, we've taken a pretty aggressive stance here. So we own this at lower levels. We've benefited from this rally and just looking to sell the covered calls now. Some concern that we've just technically got a lower high pattern occurring here where the stock has broken below recent levels, rallied back up, and we're starting to see a little bit of volume pick up on the highs. I don't think we'll get a major sell-off here in Wesfarmers, but I do think we're probably getting to a stage where it's starting to look a little bit expensive, trading at about 20 times earnings on less than a 5% dividend yield, and I don't think the company will deliver much more than about 5 to 8% earnings growth, but it will be an interesting result to have a look at over the next few weeks. Westfield, we were buyers of this at lower levels in client portfolios. As it rallied, we've then been aggressive with selling the covered calls, again boosting that cash flow up to around 10% per annum, and also giving the opportunity for some pretty decent capital gain there off the back of Westfield. So you may recall we were aggressive buyers at $9 and sellers at $10 was the story there with Westfield. Woolworths, we've taken the opportunity to start selling calls over this to drive some extra cash flow. Again, generating around 90 cents for those call options, combined with the 60, 70 cents of dividends coming up. That pushes the yield back up to around 10% as well. I think the range for Woolworths is really somewhere around $30 to around $27.50. That's allowing for not much in the way of earnings growth and a pretty stable dividend, and the stock tracking at around 4.5–5% yield. Woodside Petroleum, need to be selling covered calls over this, don't see much in the way of earnings growth. And finally, just to summarise where we're at, so hopefully the message that you've picked up from today is that we're fairly certain the equity markets are going to remain well supported as a result of global policy and a reasonable level of underlying economic growth, but our base case is that they largely move sideways. The Australian equities, where there is some certainty around growth, are relatively expensive. You need to be selling covered calls over them because there's simply not that capital gain picture that we've experienced over the past few years. So a combination of the dividend and the call option makes perfect sense where you're bumping those returns up to 10% a year. There are select trading opportunities, as we've seen with Westfield, CSL, Wesfarmers, ASX, AGL, so we have been able to sort of pick the bottom in some of these stocks and benefit from short-term rallies, but we're certainly at a junction now with portfolios where we've been aggressive with covered call options, and would encourage clients who are not running a covered call strategy to maybe give me a call, consider running an investor signals portfolio, and I'd certainly be happy to work with you to set up the model portfolio and put in place the call strategy to enhance the returns on your portfolio. If you'd like to know more, email me leon@investorsignals.com or contact me using the number on screen.